Hi, I'm Tom Lydon here in Hollywood, Florida at the Inside ETF conference. Here with Steve Sachs, head of ETF Capital Markets of Goldman Sachs. Great seeing you, Steve.
Tom, always good to see you.
So here we are, another year, 2020. Let's talk first on the fixed income side. What are advisors to do? There may be some more potential headwinds, there's maybe some more volatility. What are advisors telling you?
Well, first and foremost, Tom, it's the first conversation they want to have, which we think is very interesting. When you think about what went on in 2019, not just from a monetary and fiscal policy perspective on what went on in the rates and credit market, but essentially, right, the dynamic in fixed income and asset allocation. You and I have talked about this many times before. When you think about the returns that global fixed income have produced over the last, call it 5 years, it's not normal, right? So fixed income, first and foremost in a portfolio and an asset allocation, is a risk mitigant, and it's an income generator. That's the conversation that advisors want to have, particularly given all the flows that we saw in the fixed income ETFs in 2019. Every conversation we've had in the fourth quarter and starting the first quarter, they want to understand, what do I do in fixed income? How do I think about better positioning the client portfolio?
Yeah, and when you talk about better positioning, Goldman, known for decades about their great research around the world in the fixed income space. Specific to your ETFs, what are some unique characteristics that might be helping advisors get over some of the hurdles that might be coming?
Yeah, it's really just better construction. So when you think about evolution of anything, and fixed income ETF investing is no different. When you think about all the indices that traditionally passive fixed income is benchmarked against, they were built decades ago.
Right.
And the whole idea behind the Goldman Sachs Asset Management Access suite of ETFs, which is our brand name for our fixed income, it's really just better beta. It's beta, first and foremost, but it's just better construction. We like to say that if you could have built the fixed income indices today, instead of 20, 25 years ago, this is how you'd build them. And the whole idea is, and not just screening for liquidity, because as you know in fixed income that's first and foremost, but then it's about building a better mousetrap beyond that. We, for example, in the Access Suite, really think about it as smart beta in the fixed income space. It's about understanding the health and wealth of a bond issuer, not just the liquidity. All things being equal, so for example, in our investment grade strategy, ticker GIGB, we want to invest in debt of companies that have increasing operating margins and decreasing leverage. Why? When you do the research, to your point, when you look at that and decile out all of those rankings, the first 9, they look exactly alike. Risk return looks exactly alike. It's that 10th decile. Risk goes up 2x, returns drop by 2/3. That's what's resonating with advisors, particularly given, right? We don't know when the next bear market hits and when the next recession is, but what we do know is we're later in the credit cycle versus earlier. That's what really matters.
Yeah, and we have this kind of triple B cloud hanging over our head. Having a firm like Goldman behind you that's doing that research is really key and critical, and I know that's something you guys are looking at.
Yeah, it's really the cornerstone of everything that we've been doing in the ETF business over the last 5 years, because again, remember, we're relatively new to the ETF space still, but we're not new to investment management.
Oh, no.
Goldman's a $1 trillion global fixed income manager. It's simply delivering the Goldman Sachs expertise in the ETF wrapper.
Right, absolutely. Steve, as always, great seeing you. Thanks.
Thank you, Tom.